Today our day 21 May 4, 2025. Today our agenda is a foreign income, double taxation. So we will start our today topic and hope all the participation is joined. Before that, I'll just mute the. Before starting, if any question you guys have, let me know. I'll just open the chat also. If any question that you guys have, let me know. So let's start our today topic. Before starting today's topic, now recently in the Gulf news, French news, there is a one news regarding the waiver of the corporate tax late registration penalty. Although we not seen from FTA, but probably it will be published on the FTA portal also and the website also. But this information more likely is authentic. So this is the one of the relief that UAE authorities supported the business community. So let's start our today topic, the foreign income double taxation. What is the foreign income if we are in the UAE? So, and what is the double taxation considering the foreign income? So before starting our topic, let's have the idea of the foreign income. Although the same point we're gonna discuss the foreign income, the UAE. We are in UAE. Most of the companies, taxable person, we are considering the taxation from UAE perspective, based on the UAE resident company or UAE taxable person point of view. So this is our concern, the double taxation. Why I'm just highlighting this point and clarifying this point before starting off that, because it will helpful during the our next slides. The point of view, what is our discussion point or learning point of view? Because double taxation from the other country also perspective will be double taxation. So here we are primarily discussing the UAE. The taxable person who's resident in UAE or who's registered in UAE. Okay. So this is our concern. They might be pay the double tax. How the double tax? Maybe on the same income they are paying tax in UAE, and on the same income they might pay the tax in foreign country. The foreign country, let's take the example of the UK or USA or any part of the world. So that is called other countries. Other countries or other jurisdiction, the word other country. We are considering from UAE point of view, and same income we are paying here also tax, and the same income we are paying tax over here also. How it will become and what are the benefits and what are the relief that we can claim under the double taxation. I'm just checking if anybody have question. Okay. Hope you guys understand so far. Our main emphasis to understand what are the perspectives. Taxable person. Now the taxable person, resident and non-resident. The resident is you have the resident person also have the UE income. Plus he have the foreign income. Resident, juridical person, natural person. We are considering the taxable person. We already learned what are the taxable person that coming under the that's subject to corporates. Now we are taxable person. We already learned. Now we are saying the taxable person are resident and their income on UE income as well as foreign income, both are subject to UE taxation. On the similar basis, the non-resident person, on similar basis, non-resident person also have the UE income plus the foreign income. What is the foreign income means? The country where he is resident, country where his company is registered. Many definitions are there. So here we are understanding the non-resident person like the UK company, he will have the UK income also, for that we are referring the foreign income. Plus we are referring the UK company also have the UE income, right? The foreign income outside UAE, non-resident person guide. So the point that we are discussing, you might search the same name, foreign income outside UAE, non-resident person guideline. This is the guideline title. You must search on the Google also, you will get this detail also. Now here the point is that the Foreign Permanent Establishment Exemption, FPEE, Article 24, so is referring to the Foreign Permanent Establishment Exemption. Foreign Permanent Establishment Exemption, Article 24. We already learned about that, but now we are considering from this point of view, how we will take the double taxation relief. So here the foreign branch. What is the foreign branch? I'll just make the example again. The UE company have branch in UK. They have branch in USA. And the same juridical person have branch in, let's say, Switzerland. So now here we are saying, so is this income from this? What will be our income? From these branches, what will be our income? Anybody can let me know what will be our income? From these branches, what will be our income? Sum of all. Shahab is saying sum of all. Anybody else? I appreciate your active participation. The objective of this training to understand the concept. We all will learn. Even I'm also learning along with you guys. If you raise the more question, so our learning will be improved. Include foreign income in this gross in the city computation. So this is what we say. The gross income in the city computation. UK branch, USA branch, and the Switzerland branch who will include. What? The gross. The word is gross. What does it mean? These countries also having the taxes, maybe 15% here, maybe 20% here, maybe 25% here. I'm just giving the random percentage for understanding point of view. I'm not giving exact percentage what is the taxation in the UK, USA, or Switzerland. That is not our point. Here, only the for understanding point of view. So if this income you receive from this branch, okay, first of all, what is the income? What is the income? So from branches, we are receiving the profit and loss. What we are receiving? Profit and loss. This is the point I am just want to highlight, profit and loss. Branches are not giving us dividend. The first difference is over here. What? Profit and loss. We will take all the branches, profit and loss, which because that country already charged the taxes different percentage, we said the gross. Gross mean before, gross mean before taxation. Before taxation. If the 15%, so we'll take the gross amount before tax. That we will add up in the UECT computation. We are adding in the UECT computation. Hope the meaning of gross up. The net means after tax. Net means after tax. Just I'm giving you this after tax. Means if your income, you already paid the 15%. Let's say your income is 100% and you paid the 15% tax in the foreign country, then 85. This is the net. But this is the your gross totaling. Hope this point is also understand. Okay, the gross we understand. Foreign income must be earned by using UE resources. This is the another point. UE resources. Why the foreign income is taxable in UE? Why the foreign income taxable in UE? Foreign income must be earned by using UE resources. What kind of resources? Let's see, mostly people are familiar with the consulting or engineering services, accounting services, let's say, I think that. So if one of the company, let's say, I'll give you the example of the PTG. This company is registered in the UE. This company is registered in UK, registered in Canada. So if I have the assignment in the UK, if I have the assignment in UK, this is the UA, and this is the Canada. If I have assignment in UK, so what I'll do, I'll send employees from here for the specific internal audit or whatever the bookkeeping or accounting or taxation. I'll send the employees from here to UK, and what I'm getting, the income generating from there. What I did, the resources, which resources I used? Income generated, which resources? UE resources, because I'm sending the employee from UAE to UK to done the job for the project base, assignment base. Okay. There is a further other condition, but just grab the basic concept, then we'll go in detail. Similar basis, if I have the job or project in Canada, I will not send the UE employees. If I'm not sending the employees from here, so then this income subject to tax. This resources used by local resources. Local resources of that country. It's just for understanding point of view. Oh, here's the concept. We have to take UE resources and earn the income. What are resources? One of employee, then is the asset, cash. What is the cash? Like we have the normally in the banks or any new company in corporation or the AML, okay, or the FATCA CSR. What is this whole point? They think, what is your source of investment? What is your source of investment? The whole emphasize on source of investment. So they are asking detail of source of investment. So this is basically the point of cash we are referring. Source investment, what we say, okay, I already having the UE business. So I withdrawn the funds from here. Okay. I withdrawn the funds, and what I did, I invested in UK. So now this is making the sense of the cash. Right now it is clear that it's making the sense of the cash. Let's quickly respond. Be with me, active, and we are moving and understanding this concept. Okay. So if we understand this source, the cash we also understand. Now intangible asset. Anyone would like to give me example of tangible asset? I appreciate if anyone would like to give me answer on this. Yes, copyright, one of the examples. Brand, patents. Okay, many examples are there. IPOs are there. Intellectual property. So now, so if we having the some intellectual property, this is the comprehensive term. Thanks, Fawad. This is a comprehensive term. Okay. If we have the intellectual property and we are giving and getting the royalty, and that brand is registered in the UE, or the UE company, or the, let's say the PTG have the brand and the patent right. So they're registered, and now they are giving the branches, franchises to different country, to different people. So this copyrights or the patent or intellectual property registered in UAE. So again, his origin is registered in UAE, so he's getting the income on that. So that will be subject to tax. Okay, this is the some term we understand, some concept we take, but we are coming back to our original topic for better. Okay, now we take the example UK dividend. Here the concept we are gonna take that the dividend. Why the dividend? Why the dividend? Here the concept we gonna understand the net off, okay, and the gross off. Earlier we understand in different way. Now we are doing another way. If the UK dividend 10,000, UK company give you the dividend of the UE company. UK company give the dividend to UE company. If we receive the dividend from UK 10,000, okay, but the UK have withholding tax that is deducted at source. How much? The tax is 10%. 10% of 10,000. How much is 1,000? So this local taxation in that country from the source or from the income we are receiving. So they apply 10% and we received how much? Only 9,000. If we receive only 9,000, here we receive only 9,000. So what we'll do to include what we said gross in the city computation. Now we are understanding how to make the gross one. Net income. This is the net income. How much? 9,000. This is 9,000. Right? What is the total income? What is the total income? 10,000. So 9,000. The withholding tax is a 10%. So means this income is a 90%. 90% because 10% tax is already paid. So what we did? Income received into 100 divided by 90 because this income is a 90%. This is the formula is net income into 100. What is 100? The total income, the total 100 minus withholding tax. So earlier we are assuming that this income is 100%, but minus is withholding tax. How much? 10%. 100 minus 10 is a 90. So this point is clear over here. Mr. Adnan, it's not 110. Our standard, we have how in accounting we are calculating 100%. If we from 100 we already paid tax, 100 minus the amount of tax, that is a 10%. So this is the point I explaining over here. 100 is our total income minus 10 is the tax amount. 100 minus 10 is the 90. So this income is the 90% as of now. If you want to make the gross up, so how will do? 90,000, 9,000. How much is it? Because earlier here is the income is 100%. Assuming that 100% we paid 10% the withholding tax. So now balance how much we receive? 90%. 90%, this is the net income what we received. So we're gonna make the gross income to include in the city computation. How we'll do? This is 90. Right? If you apply the, either way, we can apply in a different way. I'm just putting the percentage for understanding. So it will be 10K. Okay. Thank you, Wilson. See, if you guys raise the point, this will be helpful for you and also understanding where we are standing while during the session. Our objective not to just cover the lecture, our objective to learn from learning point of view. Even I already mentioned, I'm also learning. If you raise some question, we will work on that. Okay, now we covered this point. So next is, what is the objective? Objective is that this income, first of all, we include 100%. Now, the next point is the foreign tax credit relief. How we can apply the foreign tax credit relief? Then participation interest exemption. This is we already learned PI in very detail. We have to see if we already have the PI, we already apply the PI, then we cannot go for the foreign tax credit relief. Why? Matching concept. If the income is not included in the UAE taxation, that we cannot apply for the relief also. First, we have to add 100% gross income. Then we will come to the relief. Then we'll come to the relief. Now the foreign income. Now let's understand the foreign income. Already we have taken some concept. The foreign income, foreign subsidiary or investment. FI we are using for the foreign income. We will continue using the FI, the short form. The foreign income. How we are generating the foreign income from the subsidiary as the investment. Subsidiary will never give you or give us profit and losses. Why? Subsidiary will always give us dividend. There is a difference we have to understand in the branch and the subsidiary. Subsidiary will never give us the profit, Will never give us profit and loss. It always give us dividend. So now in this case, we have to check participation interest exemption applied or not applied. What is the participation interest exemption? The 5%, we understand the 5% plus other condition. Then we understand the investment is more than equal to or more than 4 million. We already covered the PI. So now here the important point, another, because each topic or each concept is integrated with another the taxation regulation. The topic we are learning one by one, and we are integrating with the previous learning also. It have the integration or the linking with throughout the taxation. It's not only the one topic we learn, it will apply only that specific scenario. It will integrate maybe other perspective also. So now what we do from the participation exemption, what we will get? Dividend income and capital gain. So we have to check if these conditions are met or not met. Yes, participation exemption, no income tax, no income in city, no foreign tax credit, FTCR, foreign tax credit relief. But we understand if the PI condition is met, the dividend income and capital gain will be exempt. Yes, PI exemption. Here we are mentioning the PI exemption. If it is exempt, exempt means we are not adding the income into city computation. Then no foreign tax credit relief. Now the second, even we have the subsidiary, but PI condition is not getting met. If not getting met, income is a taxable. Income is a taxable. Foreign tax credit relief is available. Here income is not taxable. Foreign tax credit relief is not available. Along with that, the same PI, this is under PI, we already learned that. The other income, from PI we are getting the other income. These two income might be meeting the condition exempt and might be not exempt. But the other income, royalty income, management fee, interest fee, rental income, these are not under the PI. These income are not coming under PI exemption. This will be taxable. No PI exemption. All these income will become taxable. We have to add up 100%. If we paid the taxes, we have to gross and add into UECT. No PI exemption. Gross up income before tax. What we are saying? Gross up income before tax. After expenses, because tax is on profit. Tax on profit. Income minus expenses, but before foreign taxes. If the tax is paid, so now we have to gross up. How we gross up? We already learned that how we gross up. Okay, this UECT is applicable. If UECT city we are using for corporate tax. Okay. On that income, these income subject to UE corporate tax. So now how we will apply the foreign tax credit relief or double taxation relief? Get FTCR, foreign tax credit relief, DTR, double taxation relief. What is the formula? Lower of. What is the lower of? This thing UE tax on the foreign income, F5 foreign income is a 6%. This is just assumption, but we will calculate an example. If UE tax on foreign income is a 6% and the foreign tax on the foreign income is a 15%, how much the exemption we will get? How much the exemption we will get? Guys, how much the exemption we will get here? Yes, because we mentioned lower of. Lower. Okay. Although UE, but this tax is 6%. But UE tax is a 9%. How come this 6%? How come it is a 6%? Ms. Kindle, yes, your point is valid. Somebody else? I appreciate if you would like to explain this point. I appreciate because your participation itself, it will be positive for you guys also. Ms. Kindle, if you are available, please unmute yourself.
Hello.
Yes.
Yeah. So effective tax rate means we have to calculate. So tax is applicable on the net net income. Whenever we calculate at 9%, we have to derive this amount divided by total income. At that time, we will get the effective tax rate. Suppose suppose there is a loss and income. On the income, first we will apply 9%, and after deriving the total tax liability, this amount we have to divide by the total income. So whatever rate is coming, that is called effective tax rate,
Okay, thank
which
you.
might be less than the uh, our applicable rate, 9%.
Thank you. Anybody else would like to share his point of view? I appreciate if anybody else. Yes, if the Bukhari mentioned the 375 is a zero rated. Okay, guys, we are coming back to the effective tax rate. This is the point. But here, the see the step by step we are learning the grabbing the concept, and we are moving forward. Here we learn to get the all these income are taxable under UECD, royalty income, even the meeting the participation interest PI, but these income are not falling under the exemption. Royalty income, management fee, interest income, rental income, no PI exemption. We will cross up before tax, after expenses. So UECD is applicable on these income, so, but we can get the foreign tax credit relief. Foreign tax credit relief, if as per UECD, we already we will learn the foreign tax credit relief, but the double taxation relief, okay, double tax treaty, if it exists between the countries, that will prevail over the UECD law. Okay, this is the mean of DTR, double taxation relief. We are considering from that point of view, but here we are just understanding foreign tax credit relief. Here we understand the lower of UE tax on the foreign income and the foreign tax on the foreign income. If UE tax is a 6% and the foreign is a 15%, we will go with the 6%. Okay. Now the next point, this 6%, how does this 6% is came? Because actually this is the effective tax rate. Just now one of the participant is mentioned over here, effective tax rate. Now we will learn and we will understand what is the effective tax rate and what is the calculation of effective tax rate. Tax liability divided by taxable income in UAE into 100%. If the tax liability, now first we have to understand how to calculate the tax liability, right? The taxable income, then we will able to understand how it will be worked. We are not covering this, we'll come back this, but let's go next slide. Okay. Here is the example. Let's say the UE income with the income in UE with the foreign income is a 1 million. This is the foreign income. We assume that this is the foreign income and we will apply the UE tax. And we are assuming that no other income we have. We are assuming that UE income is a 0. Only the foreign income is a 1 million. So this 1 million, first 375 is a 0 rated band. What will be the tax? 0. And now the balance, what we will do? 1 million Let me know how much the amount. Minus 375. How much the amount? Yes, 625. $375. Sorry, 625. How much the corporate tax payable? Now. So now this is we applied on 625,000. 9%. So our tax payable is this. First, 375 is 0, then balance 625 at the 9%. This is the corporate tax payable. Now, here the taxable income, our taxable income is this. We are assuming that this is our taxable income and this is the tax liability. This is the tax liability. What is the formula? We said tax liability divided by 250 over 1 million into 100. 56.25. I appreciate other participants also to calculate this. Thank you, Mr. Kindle, Umar, Adnan. Yeah, Mr. Asif mentioned rightly. This is more understandable. In this way, if you write, I will understand your understanding is appropriate. Okay. Maybe due to plus and minus, due to any reason, your answer will be correct. But in the way Asif Khan is mentioned, I think this will be much appropriate while calculating or understanding the concept. Thank you, Mr. Asif. Okay, now this point we also understand. So this we already understand how is coming. Okay, now here we already understand the 6%. That was the 6% from here. So we said lower off. So now another scenario, if the UE tax on the foreign income is a 9% and the foreign tax on the foreign income is a 5%. This is paid. So which one will take? If UE tax on foreign income is a 9% and foreign tax on foreign income paid in foreign country is 5%. Which one will take? Okay. No, I believe we are on the right track. And here, one more point. I believe now we can understand the next point that I'm gonna just mention. Even one of the participants is already mentioned. But from understanding point of view, ultimate one of the condition, the foreign tax credit relief, foreign tax credit relief will be available or applicable lower off that we already understand. The point for understanding point of view in UAE, what is the maximum tax? I'm just effective tax rate or the standard rate I'm just considering, but effective tax rate always is lower. In UAE, the tax is not 9%, is in less than 9%. Why? Because the effective tax rate is different. Why? First 375,000 is zero rated band. So due to that, our effective tax rate is less than 9%. Maybe the 7, maybe 5, maybe 8.5, based on the scenario to scenario, but UAE tax is not 9%. So while doing the calculation, incorporating the costing into your sales, you will not add the 9%. You will add the effective tax rate that may be different on each entity to entity based on their income and the tax paid. On the similar basis, the free zone, if they are meeting the qualifying criteria, so they will not calculate the 9%. So maybe they are getting the advantage. Okay, they are not paying the 9% based on the other condition to be subject to that. So UAE tax is we are paying maximum is a 9%. If in foreign country we paid 5%, we will get the relief only the 5% and balance 4 will be paid in UAE. Totally the 9%. This is paid in foreign country, FC. This will be paid in UAE. How? Because we included the 100% income in UAE, gross income. Then we minus the foreign tax credit relief, the 5%, right? So we taken the lower of. So which means the balance, here we already calculated the 9%, right? When we added in the city computation, now we are applying the 9%. Or we are considering the effective tax rate, that may be 8%. So for standard understanding point of view, once we made the gross of the income, so we applying the 9%, then minus is the 5%. And the 4% is subject to tax in the UAE. This is the one of the point. So if we paid, let's assume that here we taken the scenario, if in foreign country we paid the 15%. Foreign country is a 15% and UAE tax is a 9%. So which means we paid 6% extra. What will happen with this 6%? Now the question is that what will happen with this 6%? I appreciate if you guys participate and answer on this. More people, more participants. Is there option? Okay, this year is due to higher UAE income. Higher income, we cannot claim. But the next year, can we take the carry forward? The 6% that we not able, let's say the 2024, we cannot able to claim. Can it be carried forward to 2025? Yes, it will be forfeited. It will be forfeited, wasted. Or we can apply for refund. Or we can apply for refund. We cannot carry forward. We cannot claim the refund because we did not pay in UAE. So UAE is just ensuring the minimum tax you must pay is the 9% on this foreign income. If you already paid, even you do not have the even UAE do not have the double tax treaty with that country, we still can claim the double taxation relief. Even the UAE, let's say one of the country, UAE did not sign the double tax treaty, still we can claim the foreign tax credit relief. But what will be the source document that you're requiring? The tax you paid in the foreign country, you must get the official document evidence as a supporting this much tax you paid in the foreign country. That's why you are applying for the relief in UAE. Okay, this point also is covered. Now I'm just going back to the previous slide. We left, okay. Now here the foreign branches. The foreign branches, what is the foreign branches? foreign branch is extension of the business. Never give us, or never give you the tax dividend. Is this correct or not? Foreign branches are the extension of the main business. They will never give us dividend. They will never give us dividend. They will always give us the profit and loss. Profit and loss of foreign branches take into city computation. That we understand the profit of foreign branches we will take as a gross up into UAE city computation. So one concept we already learned, the foreign tax credit relief. Now the other point, the other regulation or other benefit is the election. Foreign permanent establishment exemption. Foreign permanent election exemption. What is election means? If we offer this election, we are saying we will not bring the profit of the foreign branches to UAE. We are saying the foreign branches are not taxable in UAE. We are claiming this relief do not include foreign branches profit and losses in the city computation. If we are applying for the relief as the election, then we cannot claim the foreign tax credit relief also. Foreign tax credit relief also, because if income is not subject to tax, because we made the election, foreign permanent establishment election we made. If we made, then income is exempt, the tax paid in foreign country, no tax credit relief. Second, no election. We did not make the election. If we did not make the election, so then foreign branches profit included in the city, that's subject to UAE city. If yes, then we can apply for the foreign tax credit relief also. Foreign tax credit relief also. Any question up to here? Any question up to here? Okay. Okay, now our point is that foreign tax credit relief available on which income, or on which income is not available. FTCR foreign tax credit relief, no foreign tax credit relief on 5 income. What are the 5 income? What are the 5 income? The foreign income exempt UECD. Right? Just now last one we understand, if we made the foreign permanent establishment election is made, we cannot claim the foreign tax credit relief. Second, the foreign dividend. But if the PI exemption is claimed, then we cannot apply for the foreign tax credit relief. Same accounting principle, if income is not added as a taxable, so foreign tax credit relief also not available. The second point, if we applied for the small business relief, if our revenue, when we can apply, our revenue is 3 million or less than 3 million, only resident person. If we applied, then we cannot claim the foreign tax credit relief if even we have the income. Natural person, juridical person, both can apply for the small business relief. Foreign income during SPR time, no foreign tax credit relief. Foreign income during small business relief, so no foreign tax credit relief is available, because we cannot take exemption on exemption, or benefit on benefit, or relief on relief. Hope you are with me on this. We already opt for that. So we already, during the SPR also we learned, if we have the losses or if we have the foreign tax credit, then we have to analyze, we have to make the impact assessment, take the call based on that. It's good to make the SPR, or is good not to make the SPR. Okay. Now the third point, Now the third point, if losses, net losses, here the word, if we say that if tax losses, let's say UE tax loss 1 million, foreign income is 0.6 million, net income, net loss 0.4 million. If we have the tax loss here first, if overall is a net loss, but under that UE tax loss is 1 million, foreign income is, this is the point. We already learned this point. We already learned over here, if we have income from the foreign is 0.6 million. Sorry, if we have the loss, net loss, the net loss, UE tax loss is 1 million. And if we have the foreign income, let's make me here for better understanding. Let's take this. The 1 million is already, we have the loss. But in the foreign income, we have 600. What will happen? So if we apply this income over here, so which means our loss will be 400. But we said under the loss condition, we cannot take this foreign tax credit relief. If UE already having the tax loss, then we cannot apply the foreign tax credit relief and the loss condition. Okay. Now one of the participants, the issues mentioned, better not to opt election. This is earlier our previous learning is adding point over here. Again, this is the assessment that we already understand now is good. He remembered that point and he's applying over here. It's good that. Okay, now here we are saying in the net loss, if we are having the net loss, then we cannot apply the foreign tax credit relief. Here our learning is this. Yes, as the assessment point of view, as already mentioned, the integration or the learning from the other scenario as a whole organization, that is very important. Okay. Now let's move to the next point. Under qualifying free zone, if we have the qualifying income, what does mean qualifying income? Zero rated. If we have the qualifying income at a zero rated, if the income is a zero rated, can we take the foreign tax credit relief? If qualifying free zone, assuming that all the conditions are met and income is subject to zero rated, if we are not paying the tax, how we can claim the foreign tax credit relief? Good to all the participants. Now the next point, foreign income, okay, no foreign tax credit relief because it's a zero rate. On the other side, non-qualifying income. Here mention the qualifying income, foreign PE. Example is the foreign PE. Non-qualifying income and the qualifying free zone have the foreign PE. The qualifying free zone having non-qualifying income, and he also have a foreign PE branch. Okay. Now, next step, we have to see election is made. We already offer the foreign permanent establishment election or no. The same, if yes, then no income, no tax. If no income is subject to tax, relief is also available. Our next point, fifth point, applied natural personal relief. If we already opt for the natural personal relief, the natural personal relief is available both resident and non-resident. Under which scenario less than 1 are equal to 1 million. This 1 million means if one person have multiple income as a natural person, all income will be included. Which income will not be included? We'll learn in the next slide. So if we applied for natural personal relief, because we are saying no income tax, no foreign income, no foreign tax relief, because UAE, there is no income subject to tax in UAE. So accordingly, we cannot claim the foreign tax, foreign tax credit relief. Guys, hope the concept is clear so far. Hope the concept is clear so far. We'll go to the next slide and we'll come back. Okay, next slide, then threshold. Threshold. So what is the threshold? So now here the 50 million, there is a four threshold. Okay. First is the 50 million audited financial statement. If 50 million threshold, so full IFRS is applicable. So now our learning will be how to calculate threshold, which income will be included into threshold and which will not be included while calculating threshold. This is the question. Our question is that how we will see the 50 million threshold is met. 50 million, 3 million small business relief, cash basis, and 1 million natural person claim. So while calculating these threshold, this 1 million, 3 million, 50 million, which income must be adding? Okay. So UE source income, exempt income, foreign income. We are including. Exempt income means zero rated. Okay. So while calculating the threshold, we have to calculate all this income, UE income, exempt income, foreign income. We are not paying the tax on exempt income, but to check this threshold test, it will be part of our calculation. Let's say our UE income is a 40 million. Foreign income is a 5 million. And this income is a 10 million. So our first 50 million threshold is met or no? So which means that company subject to full IFRS. Company subject to full IFRS application. Okay. Now, the small business relief. Let's say UE income is a 2 million. Exempt income is a 5 million. Oh, sorry, 0.5 million. And the foreign income is a 0.6 million. So 3 million threshold is met or is exceeding or not met. We can go for the small business relief. We can opt for the SPR. SPR is available. Ms. Kindle saying yes. Again, think again. Some people saying yes, some people saying no. We made the total is saying 3.1 million. Here we are saying 3 million condition. Khalil is saying exceeding 3 million. Yeah. Yes, Adnan is saying right. Okay. Now, because this income is an exempt, but while checking the threshold, it exceeds the 3 million. So SPR is not available. SPR is not available. We cannot opt for the SPR. Now let's take the another exercise. The loss is 1 million as a natural person. Okay, 1 million. As a natural person, we have, let's say, the 0.5 million, and he have 0.4 million, and he have 0.2 million is the exempted. So natural person relief is available. Appreciate other participant. This is the important point. Threshold calculation is also very important. If we know all the available information, then we able to take the decision. But what is in error we are getting in the market, feedback we are getting in the market, the mostly mistake happen due to this. Most of the mistake happening due to this. People are not familiar with that. They are considering this exempt income is a 0%, so they are not adding into their threshold. And they are applying this natural person relief. They are applying the SPR. And in certain scenario, people not share this information at all. While going into deep, we pull this information. Then we come to know, okay, they think, no, this is the exempt, that's why we not shared information for you. People taking the on call while sharing the data, even the tax agent or tax consultant is helpless. Why? Because he's can do this exercise if the information or data is shared with. But this is not intentionally. They assume that this is not part of that, so they are not sharing it. How? They have many businesses as a sole establishment. Let's assume that they're saying, yes, we are doing this zero-rated activity, so it will not be part of that. So the whole entire financial information they're not sharing. Anyhow, I believe this point is clear now. Now the next point is the excluding. Now next point is the excluding. Okay. So excluding means earlier we mentioned the including. This is the including. Including while calculating the threshold. Plus. But this income is excluding. Below income while calculating threshold is exclude, which are individual salaried income. Okay. This will not be part of our threshold calculation. Next is wages and salaries. The individual is earning from there. Personal investment income. Real estate income. And this point will be here only. This individual will be here. Because as the individual, he having the wages and salaries, personal investment, real estate, these are all out of scope. These are all out of scope. Now, the point is important, out of scope. That's why we are not adding into threshold. This is the exam, that's why we are adding over there. Any question so far? Any question, please? Okay, we are starting this point. Double taxation overview. As a general rule, foreign income on any foreign source of income. This is general understanding point of view. General rule, foreign taxes on any foreign source income or gain. We already understand on how the double taxation scenario will be arise. If the UAE company having the foreign source of income or the gain, capital gain, we can understand, and the taxes paid on this income, taxes paid on that, subject subject to corporate tax will be creditable. This is the double taxation. UAE offer foreign tax credit relief in some circumstances within the domestic legislation. Note that this is the unilateral relief. It is given within the UAE corporate tax legislation that does not rely on any double taxation treaty. This is the point I'm saying. Even we do not have the double taxation treaty, still we can claim the double taxation relief. Hope you guys understand the term of the unilateral and bilateral. Anyone would like to explain this? Unilateral and bilateral. Okay. Here we already learned that even the double taxation does not rely on the double tax treaty. The double tax treaty. This is the who's saying corporate tax. As per the corporate tax, even the double tax treaty is not available, still we can claim. The original income or the profit must be included in the taxable income, gross income of the foreign tax. We already learned that we will make the gross and we will include into the UECD. The gross income is charged to tax, then any foreign tax credits, foreign tax suffered at source on that income is deductible. This is what we learn at the end of the tax computation. Okay. Let's move to our next slide. No foreign tax credit relief. Under which scenario? Under which scenario no foreign tax credit relief? Non-exhaustive list of taxes that are not considered to be of similar characteristic to the corporate tax. So no foreign tax credit relief is available. The point here, there are some taxes by nature, they will be similar considered on this under this characteristic means the properties. Just for understanding point of view, the characteristic, the properties, having the same properties are similar nature, or they are falling under the definition of the corporate tax. Right? If some taxes are not meeting the properties or characteristic of the corporate tax, then foreign tax credit relief is not available to them. This is the meaning of it. So which are the taxes? Here we mentioned non-exhaustive list. Okay. Here some of the source of income or activity is mentioned that is not falling under the foreign tax, corporate tax. Consumption tax such as value added tax. We already know the value added tax. Goods and services tax, sales tax, custom duty tax, excise tax, other form of import duty, transaction taxes, stamp tax, and capital duty. So this is the list of items. These are not considered are similar characteristic of the corporate tax. So that's why no foreign tax credit relief is available on such taxes. Custom duty we are paying to government authority, but that is not similar nature of the corporate tax. Excise, VAT. These are we will not discuss because mostly we are familiar. VAT since 2018 is there, so we are familiar on that. But still, if any specific question, I would like to take the question. If you have any specific question, so we'll answer on that. Okay, now the next is the property tax. In UAE also there is some property tax. I think maybe any participant working in the real estate, so he might share what's the name of that. I believe 4% or 5% they are paying as a property tax also. Wealth, wealth tax, state tax, or any such kind of taxes, inherent tax. Inherent tax normally in UK, if somebody died and property transferred to his kids or the family, they are paying the inherent tax, the duty. And mostly in India, Pakistan also, I believe some transaction fee is there that normally we call the stamp duty. Okay, the stamp duty, we are paying that if based on the each stamp paper, the amount is different. So that is also not under the similar nature of the corporate tax. So we cannot claim the foreign tax credit relief. Now, amount paid to foreign government as a interest. Another amount paid to foreign government as the interest, fines, penalty, or any similar obligation, not tax, are imposed on income. So here the point for our learning, we have to differentiate either this expense is meeting the characteristic of the corporate tax or no. If it's not meeting, we cannot claim the foreign tax credit relief. Because we already learned how to apply the foreign tax credit relief, but now we have to differentiate which expenses or which taxes we can claim foreign tax credit relief and which we cannot claim the foreign tax credit relief. So these are the some of the example. Government amount paid to foreign government as an interest, fines, penalty, or any obligation not tax imposed on income. But instead, as a late due to default, such as a late payment, fines, if we are paying the fine to government, we cannot take the foreign tax relief. And such amount paid in the foreign jurisdiction are not in similar in essence to corporate tax, so do not qualify the foreign tax relief. Next is zakat. Zakat operate as a tax on the income or equity, or both will therefore be considered as a similar to corporate tax. Here is a little difference. Zakat operate as a tax on the income and equity, and both will therefore be considered as a similar to corporate tax. If we have the zakat, then we can claim the foreign tax credit relief. Any question up to here? Guys, any point up to here? This slide was to differentiate what are the income we cannot, what are the expenses, are the taxes, are the duties that we paid that we cannot take the foreign tax credit relief. Now the next is the here. How to calculate the foreign tax credit relief. We already learned that, but just as an understanding point of view, again, we are going to do that. Foreign tax credit relief, double taxation relief, either the FTCR or DTR, lower of, we already learned that the actual amount of tax paid on the foreign source income in foreign jurisdiction, actual amount of tax paid in the foreign income, right? Then the amount of UAE corporate tax pay due, amount of corporate tax due. The word here is the due and here is the paid. See the difference on the foreign income. As there are two rates of corporate tax in 0 rate and 9%, the corporate tax due on the foreign source income is to be determined on weighted average basis using the following formula. X multiplied by divided by 2 x. Corporate tax due on the total income of the corporate tax before tax, any foreign tax credit relief. This we already understand. Relevant foreign tax income. I'll just give you the understanding. We already learned that how to calculate the effective tax rate. Right? We did the calculation of 5.6%, right? So if the foreign income is the 10,000, earlier we taken the lower of based on this percentage, but actually is we have to calculate. First, we calculate the effective tax rate. We have to apply the foreign income is the 10,000 multiply 5.6. Then the same 10,000 and the foreign tax rate is the 15%. Now, please give me the calculation amount of this. Please give me 10,000 into 5.6%. Yes, 560, then the 1500. So lower of, earlier we just taken the based on percentage. Now we completed the transaction also. So lower of is this A and B. So this is how we calculate. This whole slide explaining the same point. Let me know we have to if you require more understanding in this area. Foreign income, we will not take effective tax rate. We are calculating based on the UE income plus foreign income, then the total income, then we are calculating the foreign tax rate relief percentage, right? Who will having the example upcoming, you will understand over there. Okay, now let's understand this. Here the example, a UAE company incorporated and resident in UAE. Total net taxable income of 10 million. What's total net taxable income? During the relevant tax period, out of which 1 million, what is saying out of which? This is important. Out of which means this income is UAE income plus foreign income. 1 million is the net interest income earned from the country X. Foreign source income. How foreign source income? We receive from this net interest we earn from country X. How much? 1 million. So it will be foreign source income because company is incorporated and resident in UAE. So this is the foreign income for UAE resident company. In country X, company A has paid withholding tax. How much withholding tax? 50,000. Would you please let me know what is the percentage of tax in the foreign country? Would you please calculate the withholding tax percentage in foreign country? Okay. Let's see. Here, how we calculate? We will say 50,000 divided by 1 million. So it will be percentage how much we paid in the foreign country. So here we already have the calculation corporate tax including before. So this is already gross. If it's already gross, which means the foreign income is included, so we took the 1 million. Corporate tax due on taxable income. This is we are understanding how to calculate the effective tax rate. So 10 million minus 375 multiply 9%. How much the tax? This is the due tax. Okay. So 866,250. Now, how we calculate the effective tax rate? 866 250 divided by taxable income, 10 million into 100. What is the effective tax rate? What is the effective tax rate? Okay. Effective tax rate already calculated. So let's assume that less foreign tax credit relief, lower of. How much lower of? This is the actual amount we paid. Okay. This is the UE tax. How? Let's say the foreign tax. We already calculated 8 point something percentage. So now what we will do? Foreign tax or foreign tax percentage on foreign taxable income. Now 8.6 into foreign income. What is the foreign income? What is the foreign income? Multiply 1 million. So how much is coming now? 1 million into 8.6. 1 million into 8.6. So this is the 86,000. We understand how it's coming. First, we have to calculate the effective tax rate that we already done that. We have 8 points. Then we apply the foreign income, that is the 1 million. UE tax rate, UE tax on foreign income. So here, foreign tax is 50,000. UE tax is 86,000. So which we will take? Which one we will take? Which one we will take? $50,000 lower of we will take. This is the over 50,000. So now our tax payable is 866 minus foreign tax credit relief, and this is the corporate tax payable. Here is the corporate tax due on taxable income. This is the payable. Understand the difference. Any question? Let's take another example. A UAE company incorporated and resident in UAE derived a 1 million as a foreign source royalty income. Here, foreign derived 1 million foreign source royalty income. Company A, that is incorporated in UAE. This is from country B. A resident of X. At the time of the payment, the equivalent of 100 was withheld in country X as a withholding tax. What they did, they said they drive 1 million as a royalty, but the country B, they deduct 100K as a withholding tax. This is the withholding tax paid in foreign country, that is B. Right, so what is the net income is 900,000. If it's 900,000, earn this income. Now the next point, to earn this income, company A has incurred expenditure of 200,000. So what we said, in the first slide, we said before tax, but after expenses. But this amount is before expenses. So which means the 1 million, first we have to net off 200. Right? So this will be our income. Assuming that company A does not have any other income and not elect for the small business relief. Okay, this is important because if we opt for the small business relief, then we cannot do this foreign tax relief calculation. And he do not have any other income also. He do not have, and if still he did not opt for the SPR. Now we can go for the foreign tax credit relief. Foreign source income is 1 million, less expenditure is 200, taxable income is 800. So now just calculate corporate tax due, how much? Taxable income, how we'll calculate? 375,000 is a zero rated. And balance, how much will be balance? How much will be balance? You please let me know how much will be balance? 800 minus 375. Okay, 425,000. So this will be subject to 9%. What is the our tax? This will be subject to 9%. This will be zero rated. So our tax payable or tax due is this one. Now, if tax due is this, so how much we pay tax in foreign country? Withheld 100, but we can take the lower of that is 338,000. No, here we have to calculate the foreign tax rate relief also. But as long as there is no UE income, what will be our effective tax rate? What will be our effective tax rate? Yes, in beginning, we already discussed the royalty income, rental income. Yes, if we paid the taxes on that, so we can take the foreign tax credit relief on that. Royalty income, rental income. There is one more point, the interest income. So such thing, yes, if we paid the taxes on that, so we can claim on that. Okay, less. Yes, management fee also part of the same. 100,000 is paid. $38,000 being the amount of corporate tax due on the foreign source income. Balance unutilized. So here what is happening? If let's say this is the, because we do not have any other income. So how much we can take lower off? Okay. So lower off because foreign tax is 100, right? And UE tax is 38,000. So lower off is 38,000. Now 100 minus 38. So this is the balance unutilized and it will be wasted. The tax is applicable, Rehan, the tax is applicable only in profit, on the income. Okay. So first we have to calculate the taxable income. That means income minus expenditure. So this is the what we did. So you are comparing the expenditure and withheld amount. So I'm not sure what is your perspective to comparison, but our understanding would be tax calculation applicable on profit or taxable income. Okay. So first we have to net off the expenses, then we understand the before tax, but after the expenses. So this is our income. So any point up to here? Please let me know any question up to here. Let's take another example. But see here the heading is also written multiple source of foreign income. A company incorporated and resident in the UAE has earned foreign income as follows. Company A does not have any other source income, does not have any small business relief. So he have one source is this, one source is this. He paid tax this much, here he paid tax this much. So what we did, source one, source two, total is 600. So here we did the same formula, 600 minus 375 into 9%. So this is the amount is due, right? Less the foreign tax credit for the tax paid in the country X, that is the 1000. Okay. See here the scenario, what we have to do, because here the point is multiple source. So then we already have this income. So now we will calculate the effective tax rate and we'll test one by one on both separately. One here for 1000, second is 50,000. This is the second one. What is your effective tax rate? What is the upper effective tax rate? Guys, what will be our effective tax rate, please? I appreciate other people also. Okay, let's see. Lower of this 1000 we paid here. Being the actual amount of foreign tax paid in the foreign jurisdiction, fine. And this you guys calculated the effective tax rate. This is our effective tax rate, 3.75. So we apply the effective tax rate on the income that is 100. So into effective tax rate. So how much it will be? 3,300. So lower of is 1000. So we take the lower of. Now the second one, the 50,000. So what is the effective tax rate? Is the 3.3 multiply with the 500. This is the second scenario. So how much will be? So this is coming 16,875. 16,875. Here the lower of is this, and here is 50,000, and effective tax rate is a 16. So here is this. So 20,000 minus 1,000 minus 16,000. What is our answer? What is our answer? Tax payable. What will be our tax payable? 20,000 minus 1,000 minus 16,875. What is our tax payable? Quickly, please. 20,000 minus 1,000 minus 16,000. Yes. 2,375 is written here. Is written here. Why I'm doing this calculation here? For your understanding. On the other side, how much the tax we paid? 50,000 minus 16,875. 16,000. So this will be 333,125 will be wasted, forfeited. Why? Because we cannot claim this. Any point, any question, please let me know. So far, any point that you require further clarification? We almost okay. Let's take another example for the exempt income. Exempt income. So, exempt income, company A incorporated and resident in UAE. The first point, own 100% shares. Company B, company A incorporated managed in country X. That's good. Okay. A resident of country X. Company B qualify a participant. Here the PI qualifies PI, but they're saying PI condition are met. For the purpose of participation exemption, company A receives dividend income from company B. Country X withheld the withholding tax on the dividend. So let's say the company receives 1 million and they withhold 20% withholding tax. So what we will do? What we will do? I appreciate all the participant response on this. Asif Khan saying the gross. Irtada saying as PI claimed no relief. As PI claimed. Okay, somebody else. No FT, foreign tax relief. PI does mention so. Okay. More other participant, please respond on that. Other participant, please respond on that. And I appreciate, guys, please update your correct name in the Zoom also, whatever your official name, please register the same official name. Okay, now you guys understand the point here because we already met the condition of foreign tax credit relief. So that's why we cannot apply for this. Loss scenario. Company A incorporated and resident in the UAE, the following taxable income in the tax period ending 30. Okay. Here already UAE source net loss. If a net loss, so foreign country interest income is a 500. Can we claim foreign tax interest has subject to withholding tax of 5,000? Can we claim foreign tax credit relief against this 5,000? Considering that UAE is already in tax loss. UAE already in tax loss. Yes, it will be forfeited. We have to think about the other available option. Qualifying free zone. Qualifying free zone, qualifying income from the foreign source income. If you learn today less session, you can give the answer on that. Qualifying free zone. A company incorporated and resident in the UAE qualifying free zone. Company A make a loan to its wholly owned foreign subsidiary F in country F and receive interest income. And withholding tax is deducted. Yes, the word qualifying free zone, because if he's zero rated, then he cannot opt for that. Accrual versus realization basis. Okay, let's see this. Company A incorporate resident in UAE, have P in foreign country. country X. Year one, asset of the permanent establishment are revalued at fair value in accordance with the applicable accounting standard, resulting in unrealized, here the applicable accounting standard, resulting in unrealized gain. In year two, company A sell the asset of the permanent establishment, then thereby realizing gain. In year one, the unrealized gain is taxed in the country X. Here, year one is taxed on accrual basis. Company A paid tax on such income in country X. Company A has not elected for foreign permanent establishment exemption for the corporate tax. But now, here the point is that election. But the same company A in UAE, he did not make the foreign permanent establishment election. Election is not made. This election is not opt, but he made the election on realization basis. Hope you guys are remember the realization basis election. Election A and B, we said capital, asset, or revenue. Okay. So, but it has elected take into account, but they made the realization basis election A, all asset on realization basis. All asset on realization basis versus country X. Okay. That is on realization basis. That is on realization basis. So he deducted in the first year, but company A cannot deduct because he already made the realization basis. Guys, this point is clear for you guys or no? Before moving forward, just let me know. You remember the realization basis? Yes, already of no relief. Okay, let's read. It has elected. Okay. Hence, the unrealized gain is taxable in the UAE only in year. Hence, the unrealized gain is taxable when the gain is realized on sale. In year one, the unrealized gain is not part of the taxable in the company A. So, credit for foreign tax paid in the country X cannot be claimed in year one. Because in year we opt for the realization basis, so even they paid tax in the foreign country on realization basis, we cannot take the foreign tax credit relief due to difference of the election. Okay, guys, we covered today's topic. Thank you very much for your participation. Any question, please let me know.